yes. I mean, you should absolutely be worried because we came into this year thinking the Fed's going to have 6 rate cuts. Now some people are wondering if they might end up having to raise rates again. And you look at a 21 PE on the S&P 500 with inflation running over 3% and looking like it's actually, not going down. You could argue it's going up depending on which metric you look at, and go, well, based on CPI above 3%, then you go, well, the S&P should be 10% lower at a minimum based on just historical, correlations between those two things.
We're talking tech sector with Dan Niles, founder of Niles Investment Management, and we'll be discussing which of the stocks in the Magnificent Seven group are likely to outperform versus underperform, and we'll be talking about the outlook for the markets overall. Dan was on the show a few months ago. You can check out our prior interview here or in the link down below. As always, if you're new to the channel, subscribe and get updates to daily interviews with finance experts and economists. Welcome back to the show, Dan. Good to see you as always.
Good to see you too, David.
Before we talk about specific stocks that you like more than others, let's talk first about the broad market. So the tech sector overall, last year, the Magnificent Seven all moved in tandem, more or less. But this year, there's been more of a bifurcation. Some stocks have done better than others. Tesla, for example, has underperformed. We'll talk about Tesla and the others in just a bit. But why is this? Why are we seeing this diversification in performance? Is it because we're seeing a weakening of the tech sector overall, and hence we're getting some laggards? Or is this just a company-specific issue that we have to address?
Well, I think if you look at most of the companies out of the big guys that reported and guided, the quarters may have been fine, but in general, the estimates for revenues, which is what I follow the most closely, for the June quarters kind of edged down. So if you think about it, Meta kind of started off the reporting season and they guided their June quarter a little bit below the street. Stock got hit by double digits the next day off of that because expectations were high coming in. And then the next day you had Microsoft and Google report, and their stocks went up. But if you actually look at the numbers, Microsoft actually guided their revenues for the June quarter a little bit below the street. And then Google's June quarter estimates, though they don't formally guide, kind of edged down a little bit as well. Obviously, Tesla numbers went down. Also, funnily enough, the company that had missed the most quarters in a row, which is Apple, they're one of the few ones where the numbers actually held. And then obviously Nvidia's off quarter, and that's been a beat and raise, and we would expect another beat and raise coming up. So bigger picture, numbers don't really change despite all of this optimism around AI, which is clearly helping that portion of these companies' businesses. But then the rest of it is sort of, the downside in some of that is offsetting the upside coming from AI. And so that's why you've seen the market kind of churn, because the biggest, best companies, the numbers really aren't changing on the top line from a very big picture basis. And obviously everyone's a little different. We can get into that. And there's names I like and ones that I don't, but maybe that's a big picture way to think about it.
Yeah, we'll go micro in just a bit. One of the most common narratives I've heard, at least on my show, is that the 12-month trailing PE for not just the broad index overall, but for a lot of these tech names, is just really, really high and much higher than historical averages. This time may be different, but then it also may not be. And so if you take the conclusion that history repeats itself, we're due for a crash. Is that something, is that a theory you subscribe to, Dan?
Well, I mean, I think you have to be careful because I think you have to look at each of these stocks individually. And really for the past 2 years, you really haven't had to, right? If you think about 2022, everything went straight down. If you look at 2023, everything went straight up. Magnificent Seven was down 46% in 2022, and then they were up 111% in 2023. And it didn't matter if your estimates were going down like they did for Apple. The stock was still up over 40% last year, even though the estimates went down all year. And Tesla, the stock doubled last year, even though the estimates went down all last year. This year, I think with the Fed sort of on hold, not looking like it's going to hike, not looking like, maybe you even get a cut, you're going back to, well, what the fundamentals are. And But to your point on PE, each one of these is very different, right? Tesla's got a PE ratio of over 80 times, and you're talking about low single digit growth. That's very different than if you look at Facebook, for example, where they're growing revenues in the high teens, but you've sort of got a mid-20s PE. And to put it in perspective, the S&P trades at about 21 times and for revenue growth of 5%. So you're getting, triple the growth of the S&P 500 in a Meta for just a barely any kind of premium. And so each one of these is very different. And I think the risk profiles as a result are very different. Like in Amazon, you could say, well, it's at 40 times, it's expensive. But then you go, yeah, but GAAP EPS looks like it's going to double from calendar 23 to calendar 25. And that's very different than for a lot of these other companies. And then Nvidia, which is the one everybody brings up because, the stock's up so much since the end of 2022 when we heard about this thing called generative AI. But you look at the PE and you go, well, you're only paying 40 times for 100% revenue growth. Now you compare that with a Microsoft and you're paying 33 times for mid-teens revenue growth. So that's why I look at all of these names individually, and we have different thoughts on each one of them. The ones we like are Nvidia, Microsoft, Amazon, and Meta. And Microsoft's the least favorite out of the bunch because of its high PE, to your point, relative to its growth rate. And then we don't like Google from a longer term basis because of competition. PE doesn't really factor into it because it's actually pretty low. It's in the low 20s. Don't like Tesla. Obviously, it has a high PE. They got a competition issue. And don't like Apple from a longer term basis, even though it's probably our favorite in the short term, because it's got a high PE, high 20 times PE for no revenue growth over the last 3 years. So sorry if I'm being long-winded on this, but I think you need to get into each one of these. Each one's very different, whether they're expensive or not.
Well, to talk about the broad market before we move on to the individual stocks, are you concerned about a broad pullback just overall at 5182 on the S&P 500? We're already near all-time highs, which was late March. Investors are wondering whether or not this is the time to take profits. Certainly valuations, as we talked about, are high at current price levels. What's your take?
Well, you have to remember, for me, I run positions which are both long and short. So I honestly don't care that much on whether the market is up or down, because hopefully, and because of the way I run this, I can offset whatever's going on if you've got the correct shorts on versus the correct longs on. But to answer your question directly, yes. I mean, you should absolutely be worried, because we came into this year thinking the Fed's going to have 6 rate cuts. Now some people are wondering if they might end up having to raise rates again. And you look at a 21 PE on the S&P 500 with inflation running over 3% and looking like it's actually, not going down. You could argue it's going up depending on which metric you look at, and go, well, based on CPI above 3%, then you go, well, the S&P should be 10% lower at a minimum, based on just historical, correlations between those two things. And then finally, we've seen it with earnings season, where a lot of companies, Disney just last night talked about a normalization of growth, which whenever a company talks about normalization, what they mean is, yeah, revenue growth is slowing down following the surge a lot of these companies saw after the pandemic. And so from a consumer standpoint, there seems to be a little bit more pressure on the consumer. And we've heard it from multiple companies that have reported so far. And so you wonder if, okay, finally, after a couple of years since the first rate hike started, with the 10-year pretty high, oil up about 10% from the beginning of the year, all the geopolitical things going on, and the stimulus excess savings kind of running out for most people, is that all of that stuff finally starting to catch up with us. And so I think you're absolutely correct to worry about a pretty big correction at some point, because I think the thing that scares me the most is younger investors feel like, oh, you can't lose in the stock market. And to some extent, you kind of have to understand why that seems to make sense, because the S&P was up 16% in 2020 when we had a global pandemic, right? Which is double the average. So people sort of have this false sense of complacency of the government and the Fed will never let the market go down. And I think that's pretty dangerous when you have valuations as high and inflation as high as it is.
Well, a couple of things. So first, you wrote in a note to me last night that we think the S&P can advance further throughout the year without any rate cuts, assuming the economy remains solid and inflation does not move higher. So you've outlined your assumptions for a higher S&P 500. So how likely are these specific assumption variables to play out? No more higher inflation, rate cuts, either a few rate cuts, or at least not want to get any rate hikes, right? And then a solid economy. Let's evaluate these.
Well, the thing is, it's always funny, right? Because you see it with every economic release where one release will come out, it's a little bit slower, and the market will rally because then people will feel better about, oh, well, that means inflation's not going to keep rising. Then another report will come out and it's slower, and the market will sell off because then people worry about, well, the economy might be slowing down too much, right? So it's always a delicate balance between the two, which is why for me, I'm more focused on individual companies and what they're seeing in their businesses, because that will, if you have a company specific thing, let me give you an example. Regardless of whether the economy slows down or not, we're going to have a presidential election. And that means a lot of ad dollars being spent. Well, a lot of that's going to end up in social media, which means a Meta will obviously benefit from that. And so, like, I'm looking for things like that, or an Amazon where you say, well, they pick up a lot of market share during slowdowns in the economy, and they have all this excess capacity left over from COVID in their logistics business. And that's why you saw them put up a 10% operating margin versus their prior record, which was 8.2% when they reported this most recent quarter. So I'm trying to find company specific things that I don't have to worry about the economy, because let's face it, like myself included, most of us thought with the fastest rate hikes in history that we were going to see a recession last year. And obviously we didn't see that at all. And now everybody's thinking, well, there's no recession, and maybe we do end up with one. And so I think it's very difficult. And so that's why in those notes that I sent to you, I said, I'm just trying to stay flexible, adaptive with my thinking, and looking at all the data that's coming in. And I have to admit, over this last week with, different companies, whether it's McDonald's or Disney or Starbucks, all, talking pretty negatively around the consumer, you have to definitely take that into account, because the US at the end of the day is over 70%, led by the consumer for GDP. And, these things change on the margin.
Well, let's break down some of these large tech names now. First of all, how levered are the Mag 7 stocks? I ask this because there's talk now, well, actually, Jerome Powell himself said this, that rates are likely to stay higher for longer. And so the concern is that if this were the case, the earnings of these tech stocks would be destroyed if they can't service or debt at a lower rate later on. Is that a concern for you?
Yeah, and I mean, none of them really have that problem, with the exception of maybe, Tesla is its own beast, because margins can swing and cash flow can swing so rapidly, but the rest of them aren't levered, so it's not something you have to worry about. So to some degree, they're the safest names you can be in versus small cap names that have more leverage. I mean, whether it's Google or Microsoft or Meta, I mean, these companies are, Nvidia, these are just cash flow machines, with the exception of Tesla.
Okay. I'm going to start with the stocks you don't like or dislike on a longer term basis. You wrote Apple, Tesla, and Google. Starting with Google first, you mentioned that ad dollars are likely to go up during election year. I wonder why that's not going to positively affect Google.
Well, it is, and that's why I said from a longer term basis we're negative on Google, because this the ad dollars, 100% correct. That's going to help them. The flip side of it is, I'm sure you've done a lot of podcasts around AI, and you look at all the money that's being spent on AI, and you have to ask yourself one simple question. If all these companies are spending this much money on AI, do you think they're going to get a return on that? Do you think they're going to make revenues on that? If that's the case, what is going to happen to Google's 93% market share in search? Got to believe it goes down. Is OpenAI going to have, with ChatGPT going to have some impact? Is Microsoft with Bing going to have some impact, where Microsoft has only 3% share, and they've been very vocal about wanting to increase that? So, and then that's just on search. And then you look at YouTube and you can say, well, Amazon's launched ads on Prime Video just in January. That's going to clearly have some impact in terms of the ad dollars flowing to YouTube. So from a longer term basis, that's why with Google, the simple thing is, I think 93% share in search, which is their cash cow, has got to come down. And I think, yeah, and I think the way people are interacting with getting information, which is now we're using, I'm using different generative AI products right now, and they're pretty darn good, which means I'm not clicking on 10 different blue links that Google's providing to go get that information. And those are ad dollars that they're not going to be getting.
This AI theme, I know this is very broad as a theme, but as an investment theme, how sticky is it? In other words, is it truly revolutionary? Is it going to stay, or is it going to be another fad like the metaverse, which,
No,
looking back, yeah.
this is very, very, very real. I mean, it's changing every industry. This is as transformational to me as the internet was, that started in the mid-90s. And to put, you haven't asked this question, but maybe to put it in perspective, if you say, well, Netscape Navigator, which came out at the end of 1994, that kind of kicked in, which is the first, internet browser, mass internet browser, was, if you say that was the beginning of this thing we know now as the internet. And you look at Cisco, which at the time became the most valuable company in the world during that rise, their revenues went up about 15 and a half times from the quarter before Netscape Navigator showed up to its ultimate peak for Cisco in 2001. Nvidia's revenues have gone up only sixfold, from about 4 billion before this new thing called generative AI and ChatGPT and OpenAI, which we'd never heard of before that showed up in November 30th of 2022. Nvidia's revenues are up about 6x, from 4 billion to 24. So you go, well, that's up 6x in 5 quarters. You can say, well, Cisco was only up 2.5 times in 5 quarters. Yes, but it ultimately peaked it up 16 times. And so if you believe generative AI changes things as dramatically as the internet did, which I completely believe, and then the other part of this is the companies that are spending money on generative AI are the most powerful and cash flow positive companies on the planet. It's Google, it's Microsoft, it's Amazon. If you go back to the internet days, for those people who are around and remember, you had a lot of companies that were burning cash, and the only way they were able to spend money on the internet was they were going out and raising these huge deals to get the cash to spend on the internet infrastructure build out. And then a good portion of them went bankrupt in 01, 02. About 4,000 internet companies went to zero. I don't see Google, Microsoft, Amazon, Apple, Meta going to zero when we go through a digestion phase.
Yeah, but are you concerned about some of these companies cannibalizing their own products? Let me just give you an extreme example, just off the top of my head. Microsoft, which is a stock you like, which we'll talk about in just a minute. Look, who uses Microsoft Excel a lot? Well, a lot of the junior bankers, right? If they go out of jobs, for example, because of AI, I'm just saying there's other ways now you can get a financial statement done without an Excel sheet if you just use AGI.
Yeah, no, and that's why Microsoft's the least favorite of the 4 of the Magnificent Seven that we like, because with that valuation and growth rate, I'm like, well, why not own Nvidia instead? But the flip side of that is you go 3% share in search. Yeah, I think that'll go up. So you're right. It's never. That's why we started off this conversation earlier with, well, AI is helping all of these companies, but with the exception of Nvidia, the revenues for the June quarter went down slightly, but it went down because AI is helping that part of the business, but everything else is a little bit weaker. And so that's the balance, which is why I love this job, because you have to really get into the weeds and be very flexible in your thinking, because things will change. For right now, my belief is that for Microsoft, for your particular example, yes, there's going to be certain things where junior bankers, you need less bodies, etc. But on the flip side, do I think that's good for Bing and Copilot? Yes, I do.
What is Google's answer to ChatGPT?
Well, again, I don't think you can defend 93% market share. The other big problem in my mind is the corporate culture at Google, because they've been so concerned with political correctness that that's taken precedent over providing accurate answers. Now, Google has more training data than anyone on the planet. They have 9 products with over 1 billion users each, whether it's Gmail or Maps or, obviously search, YouTube, etc.
Yeah,
So in terms of putting out a great product, they should be able to put out a better product than anybody else. The question is, will they? And then the second thing is, are they willing to cannibalize search? Because they're going to have to do it to themselves, or somebody else is going to do it for them.
that's right. Yeah, and especially now with large language models being able to potentially replace search engines on a more effective scale. I wonder what Google's going to do to come up with a product. Are they going to compete with ChatGPT directly and come up with a Google version of ChatGPT, or are they just going to make, I don't know, somehow their search a little more user friendly in the face of rising competition? What's their
Well,
long
here's the
term vision,
thing.
you think?
Yeah, I mean, here's the thing. At the end of the day, when we search, we're looking for information. If we can have an AI agent, give us the answer, so we're not clicking through 10 blue links. Like, for example, I'm going to this conference coming up, and so it's like, all right, well, I got to go search for a hotel room. It's in an area I've never been before. Okay, well, which hotel has a 5-star restaurant or something? Which one's close to the airport? Like, you normally you'd put that into search, then you got to go through and click through everything. If instead I can put into a conversational AI engine and say, hey, give me a hotel that's between $200 to $300, that's within 20 miles to the airport, and that has a great restaurant and has a pool, and I put all that in, and then that AI agent just gives me the answer. That means I'm not clicking on 10 different links to find the answer, putting it into Google. And so this is going to fundamentally change the way we all operate, because we're not having, like, nobody likes to go and click on 10 blue links to get an answer, right? You just want your answer. And so, like, I
We want the
hate
choice to find the answer ourselves, Dan. No, I kid.
well, for some people it's fun. I hate it. So,
I
but
understand. Okay, well that's yeah, that is a big risk for Google. What about Tesla? You've noted in your note to me that it continues to face struggles with increasing competition from China, BYD, for example, slowing EV growth and higher rates. So yes, the EV side of their business, their actual cars facing stiff out competition from every single car brand out there making good EVs nowadays. But here's the argument from Tesla bulls now, Dan. Tesla is shifting towards a data company. Their FSD is going to be more valuable as an entity, as a product than just their cars. And so we know that Tesla, I mean, Elon Musk was just visiting China to get FSD launched there. What's your rebuttal to the fact that the data portion is more important than just their cars competing with other car brands?
it trades at 80 times, and they're firing people because Elon doesn't want to fire people. He's firing people because he has to. So that it's for me, investing is very simple. It's about risk versus reward. If you think there's a great reward at 80 times PE, be my guest. With all of the stuff you just talked about, rising competition from China, and don't forget, EV growth as a category is slowing. And we can sit here and argue about why. Is it early adopters like myself? I have a Tesla. I love it. But is it early adopters? That's the end of it. But on this trip that I'm taking, I'm not taking my Tesla because it's a long trip. It's a 3.5 hour trip. I'm going to take my gas car because I'm worried. I have what they call range anxiety, right? Like, well, how am I going to fuel it up? And, I'm going to have to leave it in the parking lot. Is there going to be an EV charger there? Then I got to drive it back. I don't want to deal with that. So I'm going to take my gas car. Whatever the reason is, EV demand is slowing down, and competition is up, and interest rates are up, which means financing these cars is more problematic. And at the end of the day, none of that matters if it's trading at a legacy car manufacturer's PE multiple in the single digits. It's not. It's trading at 80 times. That's why I have an issue with it. But don't get me wrong. Elon Musk, to me, is the most innovative CEO we've seen in our generation. He's the Thomas Edison of our generation. So if anybody can figure out how to make this work, it'll be him. But at 80 times, it's, richly valued with all the problems that they have. And don't forget, last year, the estimates, EPS estimates for the December quarter that they reported came down 50% over the course of last year, and the stock doubled. And they came down again when they reported. And now the stock is reacting to that because now you don't have, the expectation of 6 rate cuts anymore. So I think you have to balance risk and reward. And, a lot of people they look at the reward potential and they forget about the risk side of it. And the PE kind of gives you some way to think about the risk when you compare it to other vendors. And I go, well, I can buy Nvidia at 40 times. Do I think AI is changing the world? If I do, and Tesla's buying a bunch of Nvidia chips too. Why don't I buy that one? That one's growing revenues at 100% at 40 times, or I can buy Tesla that's growing revenues at 4% for 80 times. To me, that's a no-brainer.
Yeah, speaking of EV sector, what's with companies reneging on their promise to deliver all EV fleets by 2026 or 2030? Mercedes, Audi, just to name two, they previously announced that they want to have all EVs by, I think, 2026, 2027. I can't remember the year, but coming up. Right now, they're saying it's not possible. Is that from a demand perspective? Consumers aren't demanding this, or or is that an infrastructure problem? They
I
want
mean,
to, but they can't.
it's always a combination of both, right? There's the famous Bill Gates saying where technology is overhyped long term and underhyped long term, and I think that's what you're seeing with EV. You had all this hype because everybody was getting just killed by Tesla. Everybody decided to go all EV, and then they figured out, well, yeah, there's all these other issues. How am I going to charge my car, range anxiety, all this other stuff? And so you get to a certain point, you say, okay, well, I've got the first adopters like Dan Niles, who's bought a Tesla, and now I got to go get the other people. And those other people are like, well, I got to commute all the time. I don't want to have to worry about how I'm going to charge my car or whatever it is. So, and you never know what that point is until you get there. But that's what we seem to be going through right now. And so that's why you have to be adaptable in this business, right? It's like Charles Darwin said, right? It's not the fastest or strongest or smartest of the species that survives. It's the one that's most adaptable to change. And I think in tech stocks, things are changing all the time. And so you can't have this predetermined view of what you think the world's going to look like 5 to 10 years from now, because it's just stupid in my mind. You have to be flexible in your thinking. And even if your view is right, like the internet's going to change the world, it doesn't mean that Amazon stock didn't go down 95% from peak to trough from 2000 to 2002. They were one of the lucky ones because they actually survived. There were 4,000 other ones that went to zero. So I think you need to be flexible in your thinking, and also when's a good time to own these names and when's a bad time to own these names. We've owned Tesla in the past. It's just, we don't like it now.
Let's talk about let's finish off on your most bullish stock. So Nvidia on the top of your list. First of all, you said 40 times PE. Can you just clarify what you mean by that? Because I'm looking at the trailing 12-month PE. It's like 75. So you're looking at different figures here.
Yeah, I'm looking at the forward PE for calendar 24 because, that to me is that number still looks low. And so that's what I'm using for the PE for the company.
I see. Okay. Yeah, on that basis, it is undervalued relative to the rest of the index, and its peers. What is the value proposition overall of Nvidia? Is it the fact that no other competitors will catch up to what they're doing?
Well, I think, as I said earlier, right, their revenues are up 6x from before ChatGPT. Cisco's revenues peaked out at up 15.5 times from before Netscape Navigator. So I think you have a long way to go in the infrastructure build out for AI, and the companies that are spending the money are all cash flow machines versus the internet build out, where a lot of them were big money losers that were just tapping capital markets to fund.
Do you like its peers, AMD, Taiwan Semi?
Well, the TSMC is not a peer; they're a manufacturer for them, so it's a little different there. But for me, I look at Nvidia and just talking to a lot of companies, they will tell you that Nvidia has the best products on the planet. And with AMD, you may like the company, but when they reported the December quarter, the March numbers went down. And when they reported the March quarter, the forward numbers went down slightly again as well. So again, AI is doing great for AMD, but much like we started this discussion, the rest of their business is weak. I'm not having that problem with Nvidia. The numbers have gone up tremendously over this period of time. I think they, I think they tripled last year, and the stock quadrupled or something. Or sorry, I got that backwards. I think it was the stock tripled and the estimates quadrupled. So it's actually cheaper than when they started this run.
Let's finish off on Amazon. So another stock that you do like. It's the biggest hyperscaler and is seeing their cloud revenues accelerate again from 12% growth in June to 17% in March, driven by AI workloads. That's what you wrote in your note. Amazon, is it recession-proof more or less?
Well, I mean, no company's recession-proof, but they tend to gain share during recessions. And quite honestly, the reason I like it is not AWS, it's their retail business. Because as I said earlier, if you look at it, the peak retail margins were about, it was 8.2% at one of the quarters in 2021. The quarter they just reported for operating margins for the entire company was 10.7, which is a new all-time record. And so, as I said earlier, you had all this excess capacity built during COVID for their logistics arm, e-commerce arm. Now, as you're filling all that excess capacity, it's flowing through at incredible margins. And then the new revenue streams that they're adding on top of this. So again, 10%, corporate operating margins. But the ads that they're showing on Amazon Prime, those have like 60% operating margins. So you're layering in all this high profit revenues through the system. And that's why we like the name quite a bit, because it's a recession beneficiary, even though they'll be impacted by it, let's say. But they also have all of this idiosyncratic stuff that's going on right now that really should help the margins more than a lot of these other companies that are out there. And you can actually look at it now on a PE basis, which you never really have done with Amazon before, and say, yeah, it looks expensive at 40 times, but if the EPS is going to double over the course of 2 years, well, how expensive is that, especially if they benefit in terms of gaining share during a recession? And can you short other names in retail that don't gain share during a recession against it to hedge some of that risk? And so that's kind of how we think about Amazon, and that's how we have a position in it.
Well, Dan, thanks very much for your thoughts and analysis today. And for the viewers watching, if you'd like to follow Dan, he has a Twitter at Dan T. Niles, and also his website for his firm, Niles Investment Management. Links in the description down below. We'll see you again next time.